the goodwill, the group. But before I look at part B, I do want to do part C. Prepare disclosure note for acquisition subsidiary, SDR for this year, relating to cash flow. If you know how to calculate goodwill, you should know how to prepare these disclosure notes. Just need to copy these portions and put it here. This is the fair value assets of SDR at the acquisition date. On top of that, we must consider the goodwill. The goodwill based on the question is equals to 30 to less the NCI 19. 77 plus 30 minus 19 equals to 88. This 88 represents the total considerations for the 80% of the parent. Out of this $88 million, non-cash considerations. The non-cash consideration is issue of share, 84. This is the issue of share, debit investment credit share capital. This is a non-cash consideration, 84. The balance is considered as cash considerations. Thereafter, we have to consider the cash and cash equivalent acquired as part of the acquisition. This amount is 34 and put it here. The balance is equals to 30. This 30 represents the net cash inflow on acquisitions of subsidiary. If the question asks you to prepare disclosure notes, this is what you need to do. Basically, this is a rearrangement on calculating the goodwill. All this information is from here. We are required to prepare a memo, and we are required to prepare the statement of cash flow. At the same time, I want you to think about how to prepare the disclosure notes on the acquisition of subsidiary. Can we look at part B now? When you're asked to prepare the statement of cash flow in exam, you must think about what you're supposed to do before the exam. Part B, we're required to prepare PJL, Consolidated Statement of Cash Flow for the year end 31st December 2017. Normally, when you're asked to prepare statement of cash flow, you must reserve at least 2 pages for the answer. The third page onwards will be your working. First, we look at the cash flow from operating activity, cash flow from investing activity, cash flow from financing activity. There's a net increase in cash and cash equivalent. Cash and cash equivalent at 31st December 2016 and cash equivalent at the end of this year, 2017. This is the format. That's the first step. Refer to the balance sheet given to us. The cash last year is 546, this year is 1355. Remember this amount, the item that's non-cash, the pledge deposit, you have to show working to take it out, is equals to 700 and 400. For those working that straightforward, you may show the working here. As per balance sheet is 546 last year, this year is 1355. But inside this 546 and 1355, last year there's a pledge deposit is considered as non-cash. This year there's a pledge deposit 700. 546 minus 400 equals to 146 last year. This year 1355 minus 700 is equal to 655. Cash this year increased. 655 minus 146 is equals to 509. Cash increased by 509. Our job to explain is why there's an increase of 509. Before I continue, we must consider this part. This will be part of the investing activity. There's an increase in pledge bank deposit. 700 minus 400. There's a difference of $300. This 300, we treat this as an additional investment deposit, so we treat this as a cash outflow. For operating activity, the starting point will be the profits before tax. Then after that, we have to make adjustment for non-cash and non-operating item. Look at profit and loss. This is considered as profit before tax. This is the figure we used as a starting point for operating activity using the indirect method. Then you have to look back. What are the items that's non-cash, non-operating? These are the items that's non-cash, non-operating. Share of associate profit is non-cash. Interest expense is non-operating. And inside this 493, there are 2 additional items that's non-cash, non-operating. For example, is the depreciation of the PPE, gain or loss on disposable of the machinery. Interest expense. In the profit and loss, there's an interest expense of 45. And it's a non-cash item. In P&L, we minus. Now we take it out, we have to add it back, 45. Share of associate profits. In the profit and loss, we share profit with plus. Now we have to take it out, we have to minus 105. And for this question, I understand that there's a gain on disposable of PP. There's a gain of $30. This gain of $30 is a non-cash item. In the profit and loss, we plus, we take it out, now we have to minus the $30. One more item is a very common item, is depreciations of PPE. For depreciation of PPE, I think it's quite straightforward. First of all, we'll look at the depreciations of the building. For the building, there's no movement, and the accumulated depreciation increased by 37. There's no movement in the building, there's no disposable acquisition of building, and the accumulated depreciation increased by 37. This increase of 37 is considered as depreciation for the year. Building 37. Next, we'll look at machinery. Machinery, I think we have to show a working separately. Working 1. Now we'll look at machinery, cost, accumulated depreciation. We have the brought forwards, and this will be the carry forwards. We need to know the opening and closing balance. Look at balance sheet. Opening for machinery cost is 420, closing is 900. Accumulated depreciation is 330. Last year, this is 360. We will take this figure used as part of working. We have 420, 900. Accumulated depreciation last year is equals to 330. This year is equals to 360. We need to know the movement during the year, cash or non-cash. During the year, there's a disposable. The disposable is 160, there's a cost, and earlier we calculated the accumulated depreciation is equals to 40. 160, 40. And during the year, the question mentioned that there's purchase of machinery through lease. During the year, the acquired PPE through lease transaction is equals to 235. The PPE increased by 235. We need to know how much is the cash purchase. Normally, we just add it up. There's one more item that we must consider is during the year, we acquire a new subsidiary, SDL. Because of acquisition SDL, we consolidate SDL for the first time. During the year, we consolidate this 100%, increase in the asset liability that does not involve cash. The first item that we consider will be the machinery, $50. $50 is inside the closing, but the $50 is not inside the opening. This $50 increase is a non-cash item, increase due to consolidations. After that, you have to calculate the balancing figure. There's an increase of PP because of purchase, 355. This 355 is the figure that we want to calculate. It's a balancing figure. How about machinery depreciations? Again, we take this minus this. There should be a difference of $70. This $70 is an increase in accumulated depreciation because of depreciation charged to P&L. The working is very simple. You just need to take the brought forwards, the carry forwards. After that, you have to consider the plus minus to calculate the missing figure. This plus minus is the information given to us. The figure that we need to calculate is the purchase of PP is cash and the depreciation is non-cash. Now I need this figure, 70. 70. Total is equals to 107. In the profit and loss, depreciation we minus. Now we take it out, we have to add it back. If there's any adjustment, you just need to plus minus, non-cash, non-operating. Then after that, we have to consider the movement in the working capitals. Working capitals generally are referring to the inventory, trade receivable, and trade payable. For these three items, what I need to do is that I have to take the carry forwards minus the brought forwards to calculate the movement. But because for lecture purposes, let me show this as part of working 2, just for discussion purposes. Working 2, working capital. Normally, working capital is equals to inventory, trade receivable, and trade payable. The brought forwards, the carry forwards. We need to know what's the opening and closing balance. Balance refer to balance sheet. We have to take the inventory receivable, opening, and closing, and the trade payable, opening, and closing. These are the figures that we should use as part of working to calculate the movement of working capitals. Inventory opening is equal to 320. Trade receivable is equals to 383. Closing for inventory is equals to 593. Trade receivable is equals to 555. Trade payable last year is equals to 84. This year is equals to 150. We have the opening and closing, then we need to know the movement. Normally, we just take the difference and calculate the plus minus. The plus minus represent the cash movement. But before we do that, we have to ask ourselves, is there any plus minus that is non-cash, non-operating? For this question, yes. Acquisitions of SDL for the first time. During the year, acquire SDL for the first time. Consolidate SDL working capital for the first time. 10, 8, and 20. These 10, 8, and 20 are the figure that we consolidate for the first time. This figure is not inside the opening balance. This figure is inside the closing balance. Increase 10, 8, 20. These are the increase that's non-cash, non-operating. Calculate the balancing figure. 320 plus 10 minus 593 equals to 263. When the inventory is higher, the cash will be lower. 383 plus 8 minus 555, 164. When the receiver is higher, cash is lower. 84 plus 20 minus 150. Trade payable also increased by 46. This is reduced in cash. This is reduced in cash. This is increased in cash. These are the figures that I need. I show separate working just for discussion purposes. If you want, you can show this working here. There's an increase in inventory of 263. When stock is higher, cash is lower. Increase in trade receivable, 164. Receivable is higher, cash will be lower. Increase in trade payable, 46. When trade payable is higher, cash will be higher because the supplier give you more credit. Profit before tax is 553. After that, add out the columns. But before add out column, give yourself some allowance. Because in the exam, you may have overlooked certain item. If you overlook certain item, you leave some space in between, it's easier for you to come back to make amendment. 553 plus 45 minus 105 minus 30 plus 107 minus 164 minus 263 plus 46. Cash flow from operation is equals to 189. This 189, we calculated using indirect method. This may also be calculated using direct method. But for this question, we can't because we are not given the full set of the statement of profit and loss. For this question, we must use indirect method and the question asks us to do so. From this line onwards, there's no difference between direct and indirect method. The difference between direct and indirect method is on how we calculate this figure. After that, we put in the interest paid and tax paid. Again, if you want, you can show the working here. But for lecture purposes, I show this as working 3 for discussion purposes. Working 3, all the payable, interest payable, tax payable. The brought forwards, the carry forwards. Balances is from your balance sheet. Refer to balance sheet. Under liability, there is tax payable and interest payable. This is the opening, this is the closing. Normally, you have one more item called deferred tax liability, X dollar, X dollar. But for this question, there's no deferred tax liability. What if there is? What must we do? The opening balance for interest accrual, given the question is $9, closing is equals to $12. The tax payable, the current tax is equals to 69. Current tax at the end of this year is equals to 148. What if the question talk about deferred tax? Statement cash flow, we don't care whether it's current or deferred. We just need to care is what's the opening and closing. If the question also incorporate a deferred tax item, just need to plus the deferred tax opening, plus the deferred tax closing. Next, we need to know what are the movement, acquisitions of subsidiary. During the year acquire new subsidiary, we also consolidate the new subsidiary tax payable. Refer to our working early on. Refer to this working, you can see that there's a tax payable that we consolidate for the first time. It's because we adopt a full consolidation of a new subsidiary in 2017. This is the increase that's non-cash. Increased by 5, the amount account in profit and loss. In the profit and loss, there's an interest expense charged to P&L, 45. We debit profit and loss, credit the interest payable. How about the tax expense, 149? This 149 is a transaction for a year. You have to think about debit and credit. Debit profit and loss for the tax, credit tax payable. This tax payable can be a current or deferred tax. Tax payable increased by 149. Interest payable increased by 45. This increased by 45. This increased by 149. This increase are non-cash, non-operating. If there's any other item, you plus minus first, calculate the balancing figure. Cash paid. 9 plus 45 minus 12 equals to 42. This is the missing figure that we need. 69, if there's any deferred tax, plus the deferred tax, plus 5 plus 149 minus 148. 75 is the cash paid for tax. Brought forwards, carry forwards, the plus minus, that's non-cash. After that, calculate the balancing figure. This is a figure that I need. 4275. 4275. Is there any other item? You plus minus, if not, add it up. Whenever you add it up, give yourself some allowance. Because in exam, if you overload anything, you can come back to add easily. 189 minus 42 minus 75 equals to 72. This 72 represents the net cash from operating activity. For indirect method, we have to start out with profit before tax, make adjustment for non-cash, non-operating, consider the movement in the working capital. After that, you have to put in the interest paid and tax paid. This interest paid, it may be at operating activity or it may be under financing activity. If you put under operating activity, it must be after this line, after the cash flow from operations. Alternatively, you may put under financing activity. You can put under operating activity or put under financing activity. But bear in mind, it must consistently apply the presentation. If last year you put under operating activity, this year must put under operating activity. If you want to change from operating activity to financing activity, this is considered as change in accounting policy. If it's a change in accounting policy, normally you must do a retrospective adjustment. Normally you will spend half or two-thirds of time to prepare the cash flow from operating activity. Once you finish this, the rest are quite straightforward because you have all the figure view. Cash flow from investing activity. For investing activity, you must look at investment and non-current assets. Look at non-current assets in balance sheet. The non-current assets are referring to building machinery. Goodwill is a non-cash item. The cash item is relating to the purchase of the new subsidiary during the year. And investment in associate. Last year is 300, this is 330. And there's one more item is financial assets managed at fair value through P&L. Last year is 103, this is 123. There's an increase of 20. And the question mentioned that there's no gain or loss recognized in P&L. If there's no gain or loss recognized in P&L, this increase should be a purchase of investment during the year. Maybe you do this one first. 103, 123. Purchase of investment. We can show the working here. 123 minus 103 is equals to 20. Investment increased because of purchase, so it's a cash outflow. Building, there's no cash involved because there's no purchase or disposal of building. Machinery, during the year, there's a proceeds from disposable of machinery. During the year, they sold the machinery for 150. It's a cash inflow. And during the year, there's a purchase of PPE, working 1. This is the figure that we need, 355. This is the total increase, but out of this total increase, 355 is only the cash. 355 is the cash outflow. And during the year, there's a purchase of subsidiary. We calculated just now. Over here, $30 inflow for the group as a result of acquisitions of SDL. $30. $34 of cash consolidated minus $4 of cash paid to acquire subsidiary. There's an increase of $30. And the last item is talking about associate. Working for associate. Associate, remember we have to use equity method of accounting. The brought forwards and the carry forward for associate. Where do you get the opening and closing balance sheet? Last year associate is 300, this year is 330, and this year we share of associate 105. We need this figure for working. Associate last year is equals to 300, this year is 330. This is the opening, this is the closing, there's a plus minus. We need to know how much non-cash and cash. During the year we share of associate profits 105. Debit associate credit profit and loss share of profits. If there's any adjustment, you plus minus. After that, you calculate the balancing figure, 75. Why associate amount reduced? Normally, we take this as a dividend received from associate. This is the cash. $75 is the cash that we need. Dividend received from associate. I show this as working number 4. If you want, you can show the working here. 75 is a cash inflow. Add it up, 420 is a cash outflow. Net cash used in investing activity. The last item is cash flow from financing activity. Financing activity, we have to look at the share capitals and borrowing. Now look at balance sheet. Those figures I use a highlight. First of all, we look at the share capitals and the NCI, the lease liability, the bank borrowing. These are the figures that we're going to use now. These are considered as part of equity. I show this as one set of working. These are considered as liability. I show another set of working. Working number 5 is talking about equity. I put them together just for discussion. Share capitals, retained earning, NCI. Brought forwards, carry forwards. Opening share capital is equals to 1229. Retained earning is 750. NCI is at the start is 0. The closing balance for share capital is equals to 2047, 1034, and NCI is equal to 35. Opening, closing. Plus minus, what are the items given in the questions? Based on discussion during the year, we acquire a new subsidiary. Because of this acquisition subsidiary, the company issue more share, and this share increase is non-cash. During the year, the company issued $84 million of share capital to acquire subsidiary, and during the year, the company account for NCI as 19. Plus 84, plus 19, non-cash. The profits for the year shared by the parent NCI. Get this from the profit and loss. This figure here, 374 belongs to parent, 30 belongs to NCI. Share 374, share 30. If there's any other adjustment, you plus minus, calculate the balancing figure. 1229 plus 84 minus 2047. Increase in 734 because of issue of new share for cash. Retained earning, calculate balancing figure. 750 plus 374 minus 1034. There's a minus of 90. Retained earning drop because of dividend paid. Take this minus this. 19 plus 30 minus 35. So the NCI interest drop because we paid dividend to the NCI of the subsidiary. These are the balancing figure that we need. All this will be used for the statement cash flow under financing activity. Based on our discussion, we say there's a proceed from issue of new share. Working number 5 equals to 734. And based on the question, we also mentioned that the dividend paid is equals to 90. The dividend paid to NCI is equals to 14. We've discussed about the share capitals. Now look at borrowing. Borrowing is payable. Can we go back to working number 3? This is my working number 3. Just now we talked about interest payable, tax payable. Now we talk about other payable. The other payable here first is the lease payable and also the bank loan payable. We need to know what's the opening. We need to know what's the closing. The opening and closing balance from balance sheet. This liability is equals to 53,224. But this is the non-current portion. You must add in the current portion. Current portion for lease liability is equals to 60. Current portion of the lease liability at the year end is equal to 72. Current and non-current. The same apply to current tax and deferred tax. The bank loan. Opening is equals to 148. Closing is equals to 427. This is a non-current liability. There's a current liability, just add the current, Then we have to consider what are the movement. During the year, they acquired new machinery. 235. This is an increase in lease liability that's non-cash. 235. Calculate the balancing figure for these two. 53 plus 60 plus 235 minus 224 minus 72. There's a difference of 52. This 52 represents the cash paid for the lease. Bank loan. 148 minus 427, there's an increase in the bank loan of 279. This is a cash inflow, cash received from the borrowing, 52,279. Payment of lease liability equals to 52. Increase in bank borrowing is equals to 279. All these are working number 3. After that, add out the columns, 734 minus 90 minus 14 minus 52 plus 279. Net amount is equals to 857. It's a plus. This is a net cash from financing activity. If you try to add out these 3 figures, 72 minus 420 plus 857 should be equal to this. In the event that if it's not equal to this, in exam, what should you do? If you are those candidates know your stuff very well, you may want to try to rectify and check for the error. If you do not know your stuff very well, then my advice is just move on. Because the error, the differences may be due to a plus minus differences. That means 2 plus 2 equal to 5. Instead of plus, you minus. If you try to stay on this question and try to locate the error, a lot of time you make yourself more panic. My advice to you is that when you reach this stage, just move on to another questions. Because chances is that most candidates will do section A, then followed by section B. And this will be in section A. If you spend a lot of time to locate the error, which sometimes as a result of locating the error, you create more error. My advice to you is that after this, just move on to another question. That's the best you can do. There are a couple of more issues I want to discuss for this question. The dividend. This dividend may be at financing activity or as operating activity. You may put it under financing activity or you may put under operating activity. If the question is silent, normally dividend we put it here under financing activity. The interest we put under operating activity. But you can put either under financing activity or operating activity. But you must consistently apply the presentation. You should not change the presentation. And because if a change in presentation is a change in accounting policy. In the exam, you have to follow instruction. If the instruction is not given to us, normally we do the usual way. Interest pay is normally under operating activity. Dividend pay is under financing activity. For this question, is a statement of cash flow involve the acquisitions of a new subsidiary. However, it can also be a disposable of subsidiary. If it's a disposal of subsidiary that do not affect control, the cash flow will be part of the financing activity. Treat this as an equity transactions. The plus minus of the cash will be part of financing activity. This is what the question asks for part A. If it results in loss of control over subsidiary, then the cash flow will be part of the investing activity. How do you calculate this figure? If you know how to calculate the cash flow from acquisition of a new subsidiary, you should know how to calculate the cash flow from disposal of a subsidiary. It's the opposite. Let me show you. Just for discussion. Disposable of subsidiary, loss of control. Assets and liability that deconsolidated or derecognized. For example, your PP, take for example, is equals to 90, inventory is equals to 30, trade receivable is equals to 25, trade payable is a minus of 10, and there's a cash that deconsolidate is equals to 40. And do not forget we have goodwill, $20. After that, you have to consider the NCI derecognized. For example, in this figure here, NCI share $50 equals to 145. This is the parent interest. After that, we must consider the gain or loss on the loss of control over subsidiary. For example, it's a gain on loss of control, $15. 145 plus 15, this 160 represent the fair value of the parent interest. Maybe part of this is transferred to associate. For example, at fair value equals to $70. 160 minus 70, $90 is the cash received from the disposable. Do not forget you have this cash deconsolidated. This is a cash increase, then there's a cash decrease. Cash derecognized or deconsolidated is equal to 40. This is the net cash flow to the group, $50. This is the disposal of subsidiary. How this affects our statement of cash flow? When you prepare the statement of cash flow using the indirect method, this gain must be removed from operating activity. When you prepare the statement of cash flow to operating activity, you must remove the gain on disposable of subsidiary, $15. This $15 is considered as the non-cash item. For investing activity, there should be a cash receipt, $50. So this is the effect. And when we make adjustment to the PP, make adjustment to the working capital, you must consider the assets liability derecognized. For example here, disposable of subsidiary, you have to minus. When you calculate working capital, you must also consider the disposable of subsidiary. You have to minus, minus, minus to calculate the net effect if it's involved disposal of subsidiary. This is a figure I'm talking about. PP deconsolidated, inventory receivable, and trade payable. These are the figures that derecognize. That does not involve cash. Also the goodwill, NCI. When there's a disposable of subsidiary resulting loss of control, to minus here. When you calculate the balancing figure. This is one of the issue that you have to consider. Opening, closing, plus minus, and calculate missing figure. When you say plus minus, is there any other thing that you have to consider? Associate. There's a transfer from subsidiary. There's a transfer from subsidy to associate 70. Associate increased by 70 but it's a non-cash item. Increased by 70 by non-cash item transfer. It can be transferred from subsidy. It may be transferred to subsidy when a gain of control. When you do this statement cash flow, you have to study the question carefully. The whole idea is opening, closing, then you must consider plus minus. This plus minus is given in the question. After that, you calculate the missing figure. We come to the end of this session on AS7, statement of cash flow for the group.